How much can you borrow? It's the million-dollar question, sometimes literally. Your borrowing power determines what homes you can afford, but it's not as simple as a one-size-fits-all. This episode, we're talking about what borrowing power is, maximising your borrowing power, and the risks of over-borrowing. As always, I'm joined by my dad, John, property developer and mortgage broker.
How you going, Nicola? Thank you for having me once again. I'm looking forward to this episode and showing you how you can change your personal situation to be able to borrow more money to buy a property. And we'll go through a few different scenarios as well so you can understand the difference between buying a house to live in and buying an investment property.
So let's start from the beginning. What exactly is borrowing power?
So borrowing power or borrowing capacity, the banks look at your situation, goes through your living expenses, your liabilities, your income, looks at what ability you have to be able to service a loan. So it looks at your situation, and if you're buying an investment property, it also takes into consideration rental income as well, also tax deduction benefits, and basically calculates how much you can borrow.
Why does it vary from person to person so much?
Well, quite simply, everyone's situation is very different. Someone might have a HECS debt, someone might have a car loan, someone might have a credit card. Everyone's income is different. Some people have one child, no children. Some people have 4 children, which means the living expenses are higher. So there's so many different variables that can affect how much you can borrow. Some people get paid commission, some people get paid overtime, some people are casual, full-time.
So there's many different
a lot
things.
of different variables that get taken into consideration when you're looking at how much you can borrow.
So I've heard that not all lenders are the same. Why is that?
Well, every bank has got similar policies, but also they're all slightly different too. So whether it's the way they look at your income, or whether it's the way they look at your living expenses, or whether it's just the way they assess their assessment rate. Some banks have a 2% assessment rate. Some banks have a 3% assessment rate above the actual interest rate. Remember how we talked about the interest rate buffer?
Yeah.
So some banks have 2%, some banks have 3%. So every bank is different.
And every bank offers different things.
Correct. And their rates are also different too.
So Dad, would you be able to show us some real life examples?
Yeah, sure, Nicola. And anyone listening on a podcast or Spotify, go across to YouTube where you can actually see these live examples on my screen that I'm going to go through now. So the first scenario I've put together here, Nicola, is for a couple to buy their first house to live in. So I've gone with a couple rather than a single person because as a single person, you probably are limited as to how much you can borrow, and your income needs to be quite high to be able to afford to buy your first house. So I've done a couple, and I've worked on a scenario where a couple with no children buying their first house. I've put their income at around $75,000 each. I've got them with a HECS debt for both of them. I've assumed they've got credit card liabilities of $10,000, so $10,000 worth of credit cards, and also a personal loan car loan of around $30,000 with repayments of around $600 per week. So I've put those into the equation just to show you how these liabilities affect your borrowing capacity as well as HECS as well. We'll go through this scenario, take off these things, and you can actually see how it changes your borrowing capacity. So first of all, we've got HECS debt. So I've only got one of the applicants with HECS debt on this scenario. Under that scenario here, you can see what their maximum borrowing capacity is here. So with Resimac, they could borrow $653,000. And then it goes down banks from there. Yep, these are all banks. So ING 618, and it goes down to 597 with Suncorp. Now, I've only selected a handful of banks that most people are familiar with. There are also other second-tier lenders that we can speak to and work things out with, but I've just worked with some major banks that everyone's familiar with. So you can see straight away the difference between banks in this scenario is your maximum borrowing capacity is $653,000 with Resimac and $597,000 with Suncorp. And the scenario I've based this on is a 90% loan, which means the rates will also be slightly higher, which means borrowing capacity is lower. So if you do have more deposit and your rates are at 80%, your borrowing capacity would increase too. So in summary, there's quite a large difference between the best bank and the lowest bank. So you can see there's over $50,000 between two different banks there.
Yeah.
Does that make sense? Okay. So what I'm going to do now is we're going to keep HECS in place, but let's just cancel that credit card and you'll see what that does to their borrowing capacity. Let's just keep an eye on Commonwealth Bank, for example. So Commonwealth Bank, at the moment, your maximum borrowing capacity is $609,000. If we remove that credit card and change it to zero, your borrowing capacity increases to $655,000.
Wow.
So by cancelling, even if you had nothing owing on that credit card, if there's a liability there of $10,000, you can see that increased your borrowing capacity by about $45,000 to $50,000. So that's quite a big difference on what you can borrow just by cancelling that credit card.
Mm-hmm.
So does that make sense why that is?
Yes, because it's reducing the liability.
Yep, and then giving you more money in your
back.
pocket to be able to pay the mortgage, so the banks will lend you more money.
Yeah.
So a simple thing of credit cards can make a big difference as to how much you can borrow. Now, let's now look at your car loan. So this scenario here, they've got a car loan of $30,000, paying $600 per week. Again, let's just reference CBA. Current borrowing capacity is $655. We'll now remove that car loan. You go from $655 to $728. So that there, Nicola, is a difference of just over $70,000 on what you can borrow by cancelling your car loan and paying out your car loan. So $30,000 car loan gives you an extra $70,000 in a mortgage.
Yeah.
So you can see how the differences of by having liabilities reduces your borrowing capacity quite significantly. So it's important when you are applying for your loan, if you are limited on your borrowing capacity and your income is lower, the first thing you need to concentrate on is cancelling your personal liabilities. Any questions about that?
No, that all makes pretty clear sense.
So by cancelling your credit card and cancelling your car loan, it's increased your borrowing capacity from $609,000 to $728,000. So quite a huge difference as to how much you can borrow.
That's good.
By cancelling those liabilities.
Yeah.
So let's now reference back to Resimac. You can see again, there's quite a large difference between the banks again. So you got Resimac at $780,000 maximum borrowing capacity, and you got your Suncorp at $726,000. So again, there's a big difference between the banks as to how much you can borrow depending on the bank you go to as well. And the main reason for that is Resimac has an assessment buffer of 2%,
Yeah.
whereas every other bank's at 3%. So that's why Resimac is only that extra
Because
money.
they are charging you more in the interest rate.
They're not charging more. They're adding a lower buffer to the actual rate. So Resimac are adding 2%. Every other bank's adding 3%. So obviously Resimac is a good option here because you can borrow more money, but you also just have to compare their rates and make sure that their product suits you as well.
Yeah. So why does Resimac have a lower buffer?
Yeah, good question. I believe the reason is they've got other credit policies in place that are stricter than some of the other banks,
Yeah.
allowing them to negotiate a different buffer with APRA, who's the controlling body of the banking and finance industry, to be able to allow them to have a 2% buffer as opposed to 3% buffer. So there's different policies that banks go with and they negotiate that with APRA. So they've been able to do that.
Is that because they're not a main bank or?
More than likely, yes.
We did an episode not long ago on rent vesting. Would you be able to walk us through a scenario of that?
Yeah, sure. So again, very similar to what we just discussed. We've got a couple, $75,000 each, with one of them having a HECS debt.
Yeah.
So this scenario here I've got for rent vesting is where they're renting, paying rent of around $600 per week, and they're purchasing an investment property for $700,000 and renting it out for $700 per week. I've also made the assumption that they're borrowing around 88% plus mortgage insurance. So borrowing close to 90% there as well.
Yeah.
So deposit required on that one there is around $110,000 for that investment property. So again, like the previous scenario, a couple, no children, income of $75,000 a year each. I have one of them with a HECS debt. I've got the investment property at $700,000, rent of $700 per week. I have the LVR at 90% as discussed, and loan amount of around $630,000. I've left the $10,000 credit card and I've left the $30,000 car loan there as well.
Yeah.
And I've got them paying rent of $600 per week as well.
So the only thing you've added in is the rent.
Correct, yep. So under this scenario here, you can see again, they're not really servicing with anyone except Resimac. Now, what I might do is let's just cancel their credit card, put 0 there. We'll leave their car loan for now. And now they're servicing with a few banks here. So they're servicing with Resimac, Westpac, ANZ, and St. George.
So
you can see
ANZ
here,
and Westpac being the only major banks.
Correct. Yep. So you can see here they're renting and they're buying an investment property. What I want to point out here is if you're in a position where you can live at home with your parents, that increases your borrowing capacity quite significantly. So
Can you show?
I'm going to take that off now. So where I've got them paying rent, I've got them paying rent of $600 per week. What we're going to do now is take that rent out. So you can see, let's just reference St. George Bank. Let's reference ANZ in this scenario. $654,000. So we're going to take the rent that they're paying out and we're going to put in notional rent. What that means is the banks still allow a figure for them to be able to pay rent or pay board with their parents. And that figure is between $450 and $650 a month, depending on which bank. So in this scenario here now, they're not paying rent, but the bank's allowing them to pay $450 or $650 a week, depending on the bank, as an allowance to cover their expenses living with their parents, because their parents might charge them board.
Yeah.
So that's probably worst case scenario where if the parents are charging them something, the banks have already allowed for that as well. So in that scenario there, by doing that, you can see ANZ's borrowing capacity is now nearly over $1 million.
Wow, that's quite significant.
So that jumped from ANZ at $654,000 to ANZ now being over $1 million, I reckon it was. So $1 million. So your borrowing capacity increases quite significantly by sacrificing. Back to that episode with Peter Kalidas where he said, if you can sacrifice whilst you're young, it will allow you to get ahead.
Sacrifice staying at home.
So staying at home with your parents, sacrificing there, saving some more money, put money towards a deposit, but it also increased your borrowing capacity quite significantly.
Which is really good.
So this is why, Nicola, it's very important to see a broker. And I'm going to give myself a plug here. So Finance Lab, financelab.com.au, we have a few brokers that work for us that will be able to assist you, and we love helping first home buyers. So you can see if you just rang up the phone and went to Emmy Bank's sitting at $700,000, whereas ANZ sitting at $1 million. That's a huge difference between two different banks there of $300,000 on that scenario. So by seeing a broker will look at your situation and work out what is the best option for you and present them to you to help you make an informed decision. So I would say it's essential to see a broker rather than just go to the bank directly. But this can change any time as well, Nicola. So banks often change their policies and change their lending policy, which means Emmy Bank might be low now, but in 6 months' time, they might be better than Resimac because banks change their policies depending on their appetite. So at the moment, Resimac might not want much more business in this scenario. They might change their scenario in 6 months' time and try to attract more business. And what they do, they change their parameters to be able to lend more money. So banks are always changing their policy to attract business to build their
whether they're busy or not.
Correct. Yeah. So things change all the time. So although this scenario might be current, in 6 months' time that will be very different.
How about a single person dad? How much can they borrow?
So I've prepared a scenario here, very similar to the parameters we had before. I've got a single person, no children, earning $75,000 a year. I have taken off their HECS set on this scenario, and we'll add that back in a second. I've got them renting a house for $700 per week, so receiving rent. They've bought buying an investment property for $700,000, renting it for $700 per week. Again, a 90% lend. No credit cards, no personal loans at all. So no liabilities at all. No credit card, personal loan or HECS set. No liabilities, living at home with their parents.
Yeah.
They can borrow $705,000 with Resimac, $664 with ANZ, and $630 with Westpac. Again, you can see Emmy Bank are sitting at $525. So there's a big difference between all the banks again. Now, let's just add HECS in there in this scenario just to see what difference HECS makes. So if we add HECS in there, with ANZ, it actually didn't drop that much. So again, every bank is different the way they look at things. With ANZ, it dropped from $664 to $656, whereas with Resimac, your borrowing capacity dropped right down to $608,000, and Westpac $623. So
why is that?
It's all about the way the banks look at HECS and the way they do it. So every bank has different policies again, and the way they look at things.
So everything's serviceable if you are single and no HECS, and with a HECS
well, even with HECS it is. Yep. Based on that scenario, it is on $75,000, $700 per week. With HECS, you can service with ANZ living with your home with your parents. I think one niche that ANZ have, their notional rent that they use when you're living at home with your parents is $450 a week, whereas most other banks are $650 a week. So that's probably why there's a bit of a buffer there between those banks there. So that's a niche that ANZ have. So through this scenario again now, I want to show you if you weren't living with your parents and you're renting with a friend, let's assume that you're paying $600 per week for a house, but you're sharing it with your friend. So $300 a week each. So we're going to add that expense in there, and let's just see what it does to your borrowing capacity. So again, let's pick a reference. Let's just say Westpac $623,000 at the moment. Let's add in a rental expense of $300 per week.
So this is how much one person can borrow,
How much a single person can borrow to buy an investment property.
even though they're sharing rent.
Or you're
That's just
sharing,
another
you're
expense.
renting with somebody else as an expense. So we said Westpac before was $624,000. If you're paying rent of $300 per week, your borrowing capacity dropped from $624 to $514. So $110,000.
Just because you're paying an extra
a reduction of
$300 a week.
$110,000 by paying $300 per week extra.
That's, yeah.
So it makes a big difference on whether you're staying with your parents or you're renting. So moral of the story is sacrifice, try to live with your parents whilst you can.
Yeah.
Buy that investment property because your borrowing capacity will be higher. Reduce all your liabilities as much as possible. HECS might be a bit hard to clear, but at least any credit cards, any personal loans, try to avoid having any of them. Even like Afterpay and Hum and all those type of things, try to avoid any of that.
Yeah.
No liabilities at all to increase your chances of buying an investment property and trying to stay with your parents if you can.
So my biggest takeaway from this episode would be try sacrifice as much as you can by living with your parents is just one example. But also when you're thinking about getting investment property, think about the purchases that you're going to make when you're going to get an investment property and testing your borrowing capacity. So don't go buy a new car or like minimize all your expenses.
All your liabilities, your credit cards.
Yep.
And I just want to add, you might not be able to buy a house to live in straight away. So getting into the property market to buy an investment property first is probably
Better
the
than nothing.
best way to try to get into the market.
Dad, do you have anything else to add?
Yeah, I do, Nicola. So if you've got borrowing capacity there to buy an investment property and you are limited on your deposit, which you might be. Mm-hmm. Most young people are limited with a deposit. One option is to speak to your parents and see if they're in a position to offer you a security guarantee. Because what that means, you can potentially borrow 100% of the purchase price, and even with some banks, even the fees. So you can potentially buy an investment property with no deposit with a guarantee from your parents. So if you've got a good job and you're stable, you've got good borrowing capacity and your parents want to help you out, look into borrowing with them, offering a security guarantee. So the loan's still in your name, you're still responsible for those repayments. It's only if you couldn't make those repayments, they could be at risk.
Yeah, when they step in.
You've got to make sure you're in a secure position to be able to do that.
Thanks so much for this episode, Dad. I've learnt heaps and I'm looking forward to discussing more about parent guarantees and security guarantees.
Yep, very good. So
See you next week.
Keep working.